Hello, are you ready to take your life and health insurance test? Do you think that you have all the information you need, or you believe that you need some last minute tips? Or you're here just because you want to know more about insurance? Hi, my name is Alex Marquez and I'm a life and health insurance agent. I'm here because I would like to share with you all the information I got related to this topic that I think is so important. The course are going to be presented in 4 different steps. First, we're going to be working on the preparation for the test and the expectations after the test. Later, we're going to be talking about concepts related to life insurance and health insurance. And in the last stage, we're going to just be talking about separate different topics. That is, we're going to just prepare you for the test in a better way. Feel free to reach me in case of any questions you might have, and I wish you a good luck on your journey. Thank you, and see you next time.
Hi, I'm Raghavesh and welcome to Life Insurance and Annuity Ultimate Buyer's Guide. I did my Master of Science in Information Technology and I'm an analyst at one of the major life insurance companies. My knowledge in the insurance field helped me design this course from buyer's point of view. Life insurance and annuity are very important tools for protecting your financial future. Finding the right life insurance or an annuity can be overwhelming. But with the right guidance, it can be easier than you think. I have searched the internet on life insurance and annuities, but couldn't find the answers to everything at one place. So, I designed this presentation to help anyone who needs information on life insurance and annuity. To ensure everyone can understand, I tried my best to explain in simple terms and pictures. There are no prerequisites to this course. On completion of this course, you will be able to decide if life insurance or annuity is the best fit for you. I also have a disclaimer. The information in this presentation is for educational purposes only and is not intended to be a recommendation to purchase any of the life insurance or annuity products. The companies referenced or featured in this presentation are for illustrative purposes only and are not to be considered endorsed or recommended for purchase or sale. Thank you. Hi, welcome back. In this module, we will look at key people and their rights in life insurance. First one is insured. The insured is a person whose life is dependent upon by their loved ones for buying life insurance. This person has no rights on the policy unless the person is also a policy owner. The insured is the individual who goes through underwriting and shares their health records. For instance, a wife might purchase an insurance policy on her husband's life, naming herself as a beneficiary to protect her family's financial welfare in case husband died. Husband is the insured and he doesn't have any authority over the life insurance policy. Next is policy owner. Policy owner is a person or entity who owns the life insurance contract. They pay the premiums and are ultimately responsible for buying the contract. Policy owner controls everything. Policy owner can do inquiries, decide on its beneficiaries or change them, change billing methods, or request a loan. Next is payee. This person is responsible for premium payments and this person has no rights on the policy unless the person is also a policy owner. Next is beneficiaries. Only the beneficiaries named on policies can collect that benefits. This is why it's so important for policy owners to regularly review their life insurance decisions to make sure the named beneficiaries still are the people who should collect the money, especially if you have experienced a major life changes. Next is insurance company. The insurance company is a financial institution that enters into a contract with the policy owner. Company who in exchange for premium pays death benefit upon death of the insured. Next is agent. Agent is an individual or an organization that is licensed to sell a life insurance to the public. Agent is an extension of the insurance company and is appointed to offer products on insurance company's behalf. Next one is underwriter. This person is employed by insurance company. The underwriter is a professional that evaluates the risks of insuring a particular insured and sets premium for the insurance policy. Thank you. Hi, welcome back. In this module, we will look at types of life insurance. All life insurance products have few similarities. You pay premiums to life insurance company in exchange for a death benefit payment to your beneficiary. One of the biggest benefits is that it provides tax-free money to your loved ones when you die. But there are differences. Some give coverage for a limited time and some give coverage for a lifetime. Some build cash values and others do not. There are four types of life insurance: term life insurance, whole life insurance, variable life insurance, universal life insurance. Universal life is again classified into variable universal life insurance and index universal life insurance. Life insurance is also classified into term insurance and permanent life insurance. These are also called permanent life insurances as they provide life insurance for life. These are also called cash value insurance as they have savings elements added to these products. The main difference between term life and a permanent life insurance is in term life insurance, we pay premium just to cover life. In permanent life insurance, insurance company collects far more premiums to cover life and also accumulate cash. Thank you. Hi, welcome back. In this module, we will look at how whole life insurance work. The oldest form of permanent life insurance is whole life insurance. It provides a fixed level premium and a guaranteed death benefit for life. In parallel, the policy's guaranteed cash value also grows. Let's look at the life cycle of the whole life insurance. You pay a premium which is fixed for the life of the policy. As you age, the cost of insuring your life increases. However, your premium stays the same because the company projects this expense in advance and factors it into the premium at the onset. As you pay premium, the insurance company deducts all of its expenses and cost of insurance. The remainder of your premium goes to cash value. Your cash value account is created with fixed amount, predetermined by your contract at the end of each premium period. Cash value increases over time. As the cash value increases, the amount of risk coverage in the policy decreases. Dividend is also paid to participating policies, and this is not guaranteed. If you accumulated enough cash value, you can do a partial withdrawal, or you may take a policy loan in an amount not to exceed the policy cash surrender value, less the annual loan interest. When the insured die, beneficiaries receive the death benefit. If loans are not paid, that reduces the death benefit. Thank you. Hi, welcome back. In this module, we will look at how a life insurance can end. A policy can end by many different ways. Insured death. If an insured dies, beneficiaries will get the death benefit and policy will end. Next one is policy matured. When a life insurance policy matures, it has reached its maturity date and now owns the cash value or death benefit to the insured. Term insurance will not mature no matter how long you have it for. A term life insurance policy covers you for a number of years and then ends, while a permanent life insurance policy usually lasts your whole life. Permanent life insurance policies usually end at certain ages 120 these days. The age the permanent policy end is known as maturity date. Policy lapse for non-payment of premiums. A lapse means a life insurance policy is no longer an active contract due to missed premium payments. A term insurance will lapse if payments are missed. Permanent life insurance will lapse when cash surrender value is exhausted. Policy surrendered. There may come a time when you no longer want life insurance. When you surrender your life insurance, you are telling the insurance company that you don't want life insurance coverage. In exchange, the policyholder receives cash value less any loan balances of the policy for permanent life insurance. Warranty period or free look. When you buy a life insurance policy, you generally have what is called a free look period. During this time, you have the option of canceling your policy without penalty. Depending on the insurance company and the state you reside in, the free look period can be 10 days or even longer. Policy term expires. Term insurance doesn't last forever. Term insurance are in force for a term. After the term, policy expires unless you renew it. Thank you.
Hi, welcome back. In this module, we will look at how to select an agent. First thing to know before getting a life insurance or an annuity is getting to know the agent. Why verify an agent? Because you can learn important information like whether the investment professional is currently licensed or has been suspended. Remember, unlicensed, unregistered persons commit much of the investment fraud in the United States. If possible, get their CRD number. CRD stands for Central Registration Depository, which is a database that holds information about brokers and brokerage firms. Every agent licensed to sell securities in this country has what is called a CRD number. The CRD program also covers their qualification, employment, and disclosure histories. An easy way to check out an investment professional is to use the free searches provided. Go to the websites investor.gov or advisorinfo.sec.gov or brokercheck.finra.org. Once you go to these websites, provide the CRD number or name and get the agent details. The searches are free and investment professionals or firms are not made aware of these searches. Thank you. Hi, welcome back. In this module, we will look at how to select a good insurer. Many insurance companies promise to make payments many years into the future. But remember, claims payments is subject to the ability of the insurance company to pay. If the insurance company experiences financial distress, it may not be able to fully meet its obligations to you. So, how do we know if an insurance company can keep up with its commitments? What should a customer do to select an insurance company and be confident when buying a life insurance or an annuity product? Always select insurance company based on company ratings and claim paying ability. Independent agencies rate insurance companies based on their financial strength. There are several independent rating agencies. Famous ones are AM Best rates firms on a scale of A++ to D-. Fitch rates firms on a scale of AAA to D. Moody's rates firms on a scale of AAA to C. Standard & Poor's rates firms on a scale of AAA to D. But each one has its own rating standards. For example, A++, AAA are considered the best. To check the ratings on these agencies, you may need to pay and get registered. In fact, insurance companies advertise these ratings and they also put these ratings on their websites. But be sure to do some homework to check if an insurance company is showing its highest ratings or its most recent ratings. Also, make sure to understand the ratings from each rating agency. For example, AM Best A+ is close to the best rating, whereas A+ from S&P will be fifth in its ranking. Don't go with what an insurance company will say about its ratings, because companies will highlight better rating from one rating agency and ignore the lower rating from a different agency. You can also get um, insurance company details from state insurance departments. State insurance departments have consumer complaint ratios put up on their website for all the insurance companies that sell policies in their states. Consumer complaint ratios provide you with the helpful information to assess your insurance company and compare it against other companies. You can also refer JD Power US Life Insurance Study Awards. This will help you to see the customer satisfaction. Thank you.
Hi, this is the fourth module for the LLQP exam prep in Canada. This is ethics and professional practice. So in this module, we'll be talking a lot about ethics. That is, how should an insurance agent, how should they perform? How should they deal with the public? What they should be telling the public, what they should not be doing. So that is all a part of ethics. And professional practice is to understand the different companies, departments, organizations, different ways of actually doing the business. So that's what we'll talk about here. A lot of it is repeat. I would say there is a lot of repeat from the other three modules. So those where it's repeat, I'm not going to spend too much time on it. And ethics has just 4 chapters in it. So the first chapter is about the legal framework to understand about overall the types of life insurance agents. So there's 2 main types. There are independent agents and there are captive agents. So by independent, we mean that you can sell insurance from 2 or more insurers. So you are basically a broker. You are an insurance broker. You have many different insurance companies and you can sell insurance from different companies selected. But usually most brokers will deal with only 2 or 3 anyways, because it's not easy to understand all the products from all the companies. Usually you will, the independent ones, they are more comfortable with a few of the insurers, and they work through MGAs, which are the managing general agents. Those are like brokerages, insurance brokerages. And then there are captive agents. They only are working with one insurer. For example, the insurance agents working with Sun Life, working with RBC or any other insurance company, they will be captive agents. So they are only dealing with those products of that company. So in the legal framework, you need to remember, of course, we said that insurance is regulated on the provincial level, and every province in Canada has its own regulatory organization. The legal things that you should understand here that they talk about are the aspect of capacity and status of people. So what do we mean by capacity? First of all, we mean that the person should be of legal age, and they should be in the good mind. They should understand what they're buying or what they're doing. So we'll talk about that in a little more detail later on. They should be natural person. By natural person, we mean that it is an individual. It is a human being. That's a natural person. And so the natural person is a person who can actually work with. So we'll talk about this actually in more detail here in the next slides. What is a natural person? What is a partnership and legal person? Minors and guardians, power of attorneys, living will, marriage, divorce, wills, trusts, and bankruptcy. So these we will talk about in more detail in these next slides. So first of all, about the legal age. So when we're talking about capacity and status of persons, we mean what is the legal age? Anyone who is going to enter into a contract must be of legal age. For example, in Ontario, it's 18 years of age. In other provinces, it's a little different. It could be the same or different. Legal capacity means that you understand the contract and you have the positive mental capability. So they are of legal capacity. So in order to come into an insurance contract, you should have both legal age and be of legal capacity. So we said it could be a natural person, could be a partnership, could be a legal person. A natural person is a human being, a living person, and they are of legal age and legal capacity, as we mentioned above. They can enter into a contract for insurance. It could be a partnership, a company where there are 2 or more partners, and there's 2 types of partnerships. One is limited, another is general. A partner who is limited is only providing funding. He says, here's $100,000. Here, this is my contribution towards the business. If you are making money, please give me some profit. If not, then they lose their money. So that's a limited partner. The general is working in the company and also providing funding and other resources. So they can enter into insurance contract. Remember, there's buy-sell agreements where they can also act between each other, and in that way they can get insurance, crisscross insurance as a partner. The legal person, a corporation, is considered as a legal person. You can incorporate a company, and the company is considered as a separate legal entity. It has a signing officer or officers who are legally allowed to sign on behalf of the company. The company can buy property. The company can enter into contract. Company can be sued in court. So it's a separate legal entity. And this company could be for profit, could be charity, could be not for profit. So they can all enter into insurance contract. Then we talk about minors and guardians. There are minors under age 16. So they are, of course, children. Parents can apply for life insurance for the children, and the guardian must be designated. If there's no guardian, the benefit is paid to the court within 30 days. So it must be, of course, there must be a guardian. If the child is under 16 and they are going to get some money from insurance, the money has to be paid to a guardian or to the court. If they're age 16 and over, they are allowed to contract insurance on their own. They can get an insurance policy, but they can't be a beneficiary of a death benefit. So they are not able to get money directly still because they are not at the age of majority. So they can get a contract, but they cannot. So in other words, they can be owner, they can buy an insurance policy, and someone else may be the beneficiary, but they cannot be the beneficiary of the death benefit. In other words, they can't take out, for example, insurance on their parents that, God forbid, the parents die and they get the money. They can't do that. So age of majority is, like we mentioned already, it varies. It's like 18 in Alberta, Manitoba, Ontario, PEI, Quebec, and Saskatchewan. At that age, then it's a legal entity, legal autonomy. They can enter into the contract and they can get their own policy. They can be beneficiary. They can do whatever they want to as an adult. So next we'll talk about power of attorneys. The power of attorney must be original. It cannot be like copy. If it is a copy, it must be certified. And the agent cannot be a POA for a client. You cannot be acting as power of attorney for a client. Power of attorney gives you the authority to act on behalf of the other person, and you are allowed to make decisions for that person. It could be financial decisions, buying or selling property, buying or selling securities, buying or selling, getting into a contract. So power of attorney for insurance can basically do everything, but they cannot appoint a beneficiary. Everything else is okay. So they cannot say, oh, who's going to get the money in an insurance policy, but they can set up an insurance policy. They can for the person. And so there's two types of power of attorney. One is a general and the other is the enduring. So the general, it ends if the person is mentally incompetent. Then it will end. So that is the general one. And the enduring one, it continues even if the person is mentally incompetent. It continues. So under the general, we have specific. So specific could be for a particular property. So I give you power of attorney, a general power of attorney for my property at ABC Main Street. So that is a specific type of POA. If it's for financial matters only, that also is specific. So it can be defined, or it could be a broad one. You can do everything. It basically covers everything. And the enduring one, we said, is going to continue even if the person is mentally incompetent. And it must state when the POA is active. It doesn't depend on the incapability of the person. So those are the concepts and understanding of what is a power of attorney in the concept of insurance only. Of course, there's other aspects of it also. Later on, we'll talk about in power of attorney. So under marriage and common law, there are different relationships that you need to be clear about, of course, person can be married. And in this, if they're married, then there is a presumed division of property if the marriage breaks down. If there is, if two people are not married, they become separated or divorced. So then property would be divided. So if they're married, they may have a prenuptial. A prenuptial agreement is before marriage. They have an agreement about how property is going to be divided if they separate. So that is before the marriage. They're living together and they can have a prenuptial. And then they have a marriage contract after marriage. That will be the marriage contract. If they're not married, they're common law. So common law means that there's no presumed division of property. Under common law, the property is not divided. And under common law, there's no rights if the spouse dies without a will. So if one spouse dies and they don't have a will, the other spouse cannot claim any benefits or any property under common law. If they have a common law, they may have what is called a cohabitation agreement. In the marriage, it's called a marriage contract. In the common law, it's called a cohabitation agreement. That is, they're getting together, they're living together, and what do they agree on? Different things. And under common law, they can get spousal support, they can get pension support. So for if they split up, they can get spousal support, but they cannot, they don't have the right to the property division, like 50-50% as a married couple. And they can get also pension support. If one of them dies, they're entitled to around 60% of the pension of the common law person. So be sure you're clear about the difference between a married person and a common law person under Canadian law. And then, of course, there's a single person, and then there's divorced people. And divorced may have legal obligations. They may have to pay for spousal support or child support also. So those are the different relationships, those you should be aware of. Then we have a marriage and common law spouse. So this is common when you're selling life insurance, and it's you probably will have to deal with these, understanding them. So spouses usually they buy insurance to provide for the financial well-being, and of course legally they can be married, they can be common law, they can be same-gendered also. It's legal here in Canada. They might be required. So like we said about spousal support or child support, by law, the court usually will say that if there's a marriage breakdown and one spouse has to give the other spousal support or child support, then they also want life insurance to be there. So if the person dies after a year, 2 years, 5 years, then the children or the spouse will not be disadvantaged. So there usually will be a requirement for life insurance as a result of the breakdown. So there are issues which arise around values contained in the policy when there's a divorce or separation. So if there's in Quebec, except in Quebec, divorce has no effect on beneficiary designations. So if you have a policy, you must, and if you have a policy and there's a division of relationship, you leave somebody in, you must make the change in the beneficiary of the insurance policy. It's not automatic. It's not considered as if, oh, you broke up the relationship and now the beneficiary is automatically, it does not automatically change. You have to send in a new beneficiary form to the insurance company, otherwise the same one stays in the designation. In Quebec, where spouses is named as beneficiary, it is automatically irrevocable unless the owner otherwise indicates it. And divorce cancels that designation in Quebec only. So Quebec rules are a little different, but rest of Canada, it does not affect the beneficiary designations. Okay, next we're going to talk about wills, estates, and successions. And so under wills, all property is deemed disposed of by the person at death. So when a person dies, there will be, usually every person has a will, and it's considered when the person dies that all the property has been sold, although it's not sold, but it's considered as if it is sold. And this property, once it is sold, like rental property, principal residence, it flows into an estate account. Estate account is an account which is opened up in the bank, which will, all the assets are liquidated and put into the estate account. And then the money in the estate account is divided as per the will. In the will, it will say, I want my assets to be divided so and so. The instructions made by the testator, the testatrix, if it is a female, and carried out by the executor. So the person who is making the will is known as the testator, and the person who is executing it, who is making sure that the will is, the money is divided as per the will, is called the executor. You have to, when you write a will, you have to name also who is the executor. So joint tenancy, property, and life proceeds are dealt with outside the will. If you have a joint ownership of a property with a spouse, one spouse dies, the other spouse automatically gets ownership of that property. This includes joint bank accounts, and includes joint property with joint names on it, and other joint ownership items. So that you do not have to mention that in the will. Automatically, it's considered one person dies, the other gets full control of it in joint tenancy. If you don't have a will, it's known as dying intestate. It means you're dying without leaving a will, and the assets are distributed according to laws of intestee in your province. So each province has its own rules. If you do not make out a will, there's laws based on Ontario province, based on BC. Every province has its own rules, how the property will be divided with the spouse and the children, etc. Usually in Canadian law, parents do not get any um, rights for division of property. So you need to designate if you want it done differently, if you have other religious or other personal desires, you need to mention that in your will. Otherwise, the property is divided according to the laws of the state. Okay, I'll stop here and we'll continue with the next in the next meeting. Okay, thank you very much.
Hi, I'm Nicole, and I want to welcome you to today's course. Today, I'd like to take you on a short journey through the art of storytelling and learning how to apply some very simple financial principles. I find that in the last going on 13 years that I've been working with individuals like yourself who are just really trying to put together the puzzle pieces of their overall financial lives, sometimes it's easier to tell a story and show how each of these financial principles and tools can fit into someone's life. So, my hope today is that you will check out this course about Tangi, learn about how she decided to set her financial life up in order to be able to protect her assets and pass on that generational wealth to the next generation. And maybe you can find some tools and tips that you can apply to your own life. Now, this is a very short course, so don't expect to spend much longer than 30 minutes here with us today. There's one short assignment that is designed to get you started on your journey and help you learn how to find financial independence and overall financial stability. I hope you enjoy the course, and if you have any questions or concerns, feel free to reach out. I'd love to be able to interact with you and answer any questions that you have. Thanks. Welcome to Accelerate Your Wealth with Urban Cash Coach, personal and business finance for everyday people. On this webinar today, we're going to discuss a client named Tangi. Tangi is a young mother who was recently widowed and she's purchasing her first home. She is a first-time home buyer in her family and she understands the importance of being able to build wealth and leave a legacy for her family. Let's learn a little bit more about Tangi and how she's working with her financial advisor and insurance agent to make sure she's able to pass on a legacy. Tangi is 33 years old, and the home that she's purchasing is $165,000. Her mortgage is a 30-year mortgage at 4%. Tangi wants to keep this home in the family for her 3 children to have a hand up later in life. Tangi is going to protect her home with life insurance. She's going to use living benefits just in case she becomes chronically or critically ill or passes away before the mortgage is paid off. Now, I don't know if you've ever heard of living benefits, but I'm going to tell you a little more about them and why we want to include those in the insurance policy for Tangi. So living benefits allow a person to use a portion of their life insurance while they're still living to take care of financial needs or pay for the policy. So when we think about Tangi, she's a single woman and she's got 3 children she's responsible for. So all of the things that could potentially put her asset at risk, her home, is if she were to become disabled and no longer be able to go to work and take care of her financial needs. So her insurance agent definitely wants to add on a disability waiver. That waiver is going to pay for the policy premiums if she becomes disabled. So that means she'll never lose that life insurance policy because it's going to be being taken care of by the insurance company all the way until she's about age 60 or maybe 65, depending on the policy. Critical illness. This is going to accelerate some of the life insurance for financial needs if she's diagnosed with a critical illness like cancer, stroke, a heart attack, or AIDS. And then chronic illness. This is something that's going to be going on long term, and it may leave her in a situation where she can't perform 2 or more of her daily tasks. She may need help getting dressed, or going to the bathroom alone, or feeding herself. All of those things will trigger a living benefit for her life insurance. So this means that in her policy, she doesn't have to wait until she's deceased in order to access her money. These companies who offer living benefits policies will allow her to get a cash installment on a regular basis. It may be monthly, it may be one lump sum, depending on how it's arranged, but she's going to be able to get access to cash from that policy to be able to take care of her needs right now while she's alive. So in this case, she wants to make sure she can keep her premium paid. She wants to make sure that she can continue to pay for her mortgage and protect her assets so that she can pass them on to her children. Now, we have to determine what's the right kind of life insurance for Tangi. Well, Tangi's got a limited budget because she's a widow and she has 3 young children. She works at a local credit card collection firm and she makes $60,000 a year plus a quarterly bonus. She gets $700 a month in Social Security benefits from her deceased spouse, and she owes $90,000 in student loan debt, and she also has a car note and several credit cards that she's used to purchase furniture and other needs for the family. After she sat down with her cash coach, she determined that her budget for insurance is only $40 per month. Now, health is wealth, and that really, really shows when we talk about life insurance for Tangi. When we talk about life insurance, the most competitive rates are going to be for the youngest and healthiest of all of the applicants. So here's what we know about Tangi. Tangi has a great BMI, her body mass index. When she goes to visit the doctor is very pleased with how much she weighs in relationship to her height. She visits her doctor regularly for her checkups, and Tangi does not smoke. She does not use any illegal drugs. She doesn't have any family medical history of chronic illness or critical illness, and she also doesn't take any prescriptions. So because of that, Tangi is eligible for the very best rating for her insurance. So at $40 a month, Tangi's able to purchase $250,000 of term insurance that will last her for 30 years. So it matches up exactly with how long her mortgage is. $39.10 per month is exactly how much it's going to cost her. And that includes all of those additions that we talked about. As you can see here on the screen, this is her actual quote. So she's got critical illness, chronic illness, terminal illness, disability premium waiver, and then also a children's term rider. So not only did she make sure she covered all of her expenses, so in that $250,000, she's covering her mortgage if she dies unexpectedly. Then that leaves her with a little bit of a cushion to pass on to whoever would be responsible for taking care of her children to continue to pay for whatever their needs and expenses are based on her budget. She's also covered each of her children for $10,000 in life insurance coverage. In the event that something would happen to any of her children between their age today all the way up through their age of 25, she has at least a final expense policy to take care of whatever their funeral expenses are. So, while she's met with her cash coach, she is trying to determine how she can get this wealth moved over into a position of ownership versus a liability. So we all know that when we get a mortgage is technically a liability, right? That means that we owe someone for that particular home. If we are not able to pay it, they can take the home back from us. We want to transition from a liability to an asset as fast as possible. So when Tangi meets with her cash coach, we start to sit down and devise a plan. So Tangi's cash coach has helped her find a side hustle, and she's going to sell some $5 jewelry from a popular $5 jewelry sales organization. And her goal is to make an extra $200 a month, and she's going to tighten up her budget so she can start to pay off her credit card debt and live below her means. Now, what we want to do with that $200 a month is we want to apply that to the principal amount of her mortgage each and every month. So the remaining balance, because she just purchased the home, is $165,000. If she pays $213 extra per month, the loan will actually be paid off in 20 years as opposed to the 30 years that she's scheduled to pay it off in. That's going to result in $43,726.48 saved just from interest payments alone. So that's a big deal. When we are paying a mortgage, the principal and the interest as that continues to rack up over time, we almost are paying for our homes double just when you calculate in what the interest rate is because we are borrowing money. So if you look here at the diagram, it tells you her original payoff schedule. Now, this doesn't include her insurance or her taxes or any of her escrow. This is principal only. Her principal only payment before was $787.74. And if she had gone out that whole 30 years, she would have paid $283,000 plus, a total of $118,000 in interest. Now, just by selling her $5 jewelry, increasing that payment every month by $213, she's only going to pay $74,000 in interest over time. And instead of $283,000, she's going to be making a total payment of $239,000. So she is really pushing hard to accelerate those payments and get that home paid off faster so she's in a wealth position. Now, we understand she's got 3 children, and so she may not always be able to add that $213 a month. So we also build in the plan that she could potentially use $2,500 of her tax refund each year, apply that to the principal balance of her mortgage, and still get the same result. Now, let's check in about what we know about Tangi. Tangi will have her mortgage paid off in 20 years. She will have protected her assets for her family in case she became ill or died unexpectedly. She owns the house outright. Her home is now an asset with equity. Now she's 53 years old and she's debt-free, and her children are young adults now starting their own lives. Look at Tangi. Now what? Now let's do another insurance policy review for Tangi because we purchased Tangi a 30-year term policy. Now, a 30-year term policy means that that policy is only going to have a locked-in premium of her $39 and change for 30 years. At the end of that 30-year period, the cost of the insurance can increase and will likely increase dramatically, and then it will continue to increase at normal intervals, and typically that means every year. So in this case, had she kept her policy, at the end of 30 years, she would have gone from paying about $40 a month to potentially paying $600 or $700 per month in order to keep that same coverage. And every year, that policy would have gone up and up and up. So we don't want to have her in that particular state. Now, some people may choose to just stop here and say, hey, my house is paid off, my kids are grown, and now I don't need any more insurance. I just need enough to be able to take care of my final expenses, to cover my funeral and, those things. And if that's you, that's fine. You've made it to the finish line. In Tangi's case, she wants to be sure that she can leave a legacy. So she already has the home that she'll be leaving to her children. The next thing is she says, hey, I think I want to maintain that $250,000 because it'll be nice for my children to inherit both a home and $250,000 in cash that's going to transfer to them tax free at the time that she passes away. So, what can we do now? Well, we're going to take a look about converting her life insurance policy and making it a permanent one. Term insurance is, like I said, more of an if you die policy. So if Tangi died within the first 30 years of that policy, then the insurance company would pay $250,000 to her beneficiaries. After the 30 years, because the pricing of that policy goes up so drastically, or she may decide to go ahead and cancel it after 30 years, then we may not have the coverage. A permanent policy is going to be a when you die policy. So it doesn't matter if it's on day 1 or if it's on day 10,001. That policy is going to be available for her at the same premium pricing with very few changes for as long as she lives. So she looks like she's going to be living a long, healthy life from what we can see. So let's check in and see what. So Tangi is now approaching retirement. And unfortunately, she's gotten diagnosed with a rare cancer. So she's able to go to work while she has her treatment. So she doesn't need to tap into that disability waiver. But she's not able to get any more life insurance. So now she's in a little bit of a pinch because if she needs to try to get a new policy, she no longer qualifies. And this happens very often. As people get older, more and more things kind of happen to us in our lives that prevent us from being able to get substantial life insurance just due to the underwriting. So in this particular case, she wants to make sure her children get that money. And what we're going to do is we're going to convert her term policy into a permanent policy. Now, this is important because all term insurance policies are not created equal. So every term policy does not have a conversion privilege, and all term policies do not allow you to convert for a long period of time. This term policy that Tangi is looking at, or that Tangi has purchased, has a 30-year term conversion option, or until she's age 65. So, whichever gets here quicker. So since she bought the policy at age 33, her 30-year term takes her all the way up to age 63, and she has that full time frame to be able to convert. Now, we want to go ahead and convert that policy over to a permanent one. So if she wants to keep her $250,000 in coverage and all of the same benefits that we talked about earlier, except for the child rider because the children are grown, she's going to now have to pay $350 per month. Now, wait a minute. I know you're probably thinking that is really high. That's a lot of money for some life insurance. Yes, that is. Probably a little bit more money than what you would expect or what you're used to. However, let's remember this. Tangi now has a disease that prevents her from going out and getting insurance. If she was healthy at age 53 and as healthy as she was when things first started, we may want to go out and get her a new quote now and see if we can get her a policy that may be a little bit more affordable. But she doesn't have insurability anymore. But because we sold her a convertible policy, her current health status doesn't matter. The company is going to base her health status based on her 33-year-old self. Now, they're not going to give her the 33-year-old pricing, but they are going to assume that she is still as healthy as she was when she was 33. So now converting her 33-year-old health history over onto a policy at age 53, the new cost is about $350 per month. Now, do you think Tansy can afford that? Absolutely, because her home is paid off now. She just saved $43,000 in interest by paying her home off early, and she still has a side hustle. Her kids are grown and out of the house, so her expenses are way lower. So she can definitely afford that $350 a month to maintain this policy. Now that we've transferred to a permanent policy, that permanent policy is also going to accumulate some cash value in it. So, Tangi's new permanent policy is guaranteed to pay out $250,000 at minimum at her death, and she still has the same living benefits. Look at Tangi. Tangi got her a boo now. At age 65, we looked at the policy, and there's going to be some cash built up in it. And she's told her cash coach that when she retires, she wants to be able to take a trip around the world, and she thinks that trip's going to cost her about, $10,000 or $12,000. And we've built in the opportunity for her to take $12,000 in cash out of her permanent policy when she retires in a little over 10 years, and she can have that cash tax free out of her permanent insurance policy, and she can go on that vacation, that dream trip that she's been wanting to go on. So Tangi set out to leave a legacy of wealth and assets to her family, no matter what. She understood that it was important to protect her most valuable asset from all the risks while her children were young. She had a plan with a paycheck attached to it if she had any major medical challenge or an unexpected death that would drastically affect her income or ability to pay off her home. When she gets that final call to glory, and we all know that that's going to come for each and every one of us at some point, her family will be in a wealth position that she was not set up for herself. As a single mother, a single widow, she was able to amass almost $500,000 in wealth to pass on to her children because she got at least the $250,000 in death benefit, plus the home that she purchased way over 30 years ago that started at $165,000. So assuming that the value of that property is continuing to appreciate as we want our assets to do, that home could very well be worth $250,000. So now she's passed on $500,000 in wealth to the next generation. So now that's set up her children for an amazing start in life. Maybe they already have everything they need. So perhaps they use that money and they invest it. Maybe they use that money and do the same thing and purchase another life insurance policy for their family. Maybe they have enough money to purchase a permanent policy when they're younger so that they can basically rinse and repeat that entire program. Perhaps they use it to pay off their homes that they purchased. But what you have to know is that it has given her children and her grandchildren options that they would not have had otherwise. Now, this is extraordinary. A 2017 study by Prosperity Now concluded the median wealth of African Americans would be zero by the year 2053 if nothing changed. In order to promote generational wealth, Black families must accelerate the ownership of assets that appreciate in value, well as pass them on to the next generation. That is the largest issue that we have. We have definitely turned the corner and begun as minorities to learn how to acquire assets. We're learning to go and purchase real estate. Now, what we've yet to see is 100% of those purchases making it to the finish line and then having something to pass on to the next generation. Oftentimes, these homes that are being purchased are being lost. And the number one reason why we are not able to make it to the finish line is typically something related to a health-related issue or an unexpected death, which is why in this webinar, we use Tangi as a case study example of how to prevent those top reasons why we're not able to accumulate and transfer wealth onto the next generation. So I'm the Urban Cash Coach, and we've partnered with Go Fund Your Life to help more people like yourselves achieve financial freedom and create generational wealth with personal financial coaching and insurance services for individuals and businesses. No matter the income or circumstances, we have an opportunity to be able to help you. If you are like Tangi or you know someone who's like Tangi, please do me a favor, share this webinar with that person, ask them to get in contact with us as soon as possible. Contact us for a free consultation so that we can put you in position to accelerate your wealth and lock in the opportunity to pass on wealth to the next generation. You can visit us at gofundyourlife.com. Click on Cash Coaching to schedule for your individual wealth plan. You may also call our office at 866-906-GFYL. That is 866-906-Go Fund Your Life, GFYL. Thank you so much for taking the opportunity to watch this webinar. If you have questions, comments, or concerns regarding the webinar, feel free to reach out to us. My email address is info@gofundyourlife.com, and we'll be happy to answer any questions that you have and follow up in our communications. Thank you very much.
Welcome to Close the Sale. My name is Jason Tiedick, and I help financial advisors communicate in a style unique to them.
I'm Carl Detman, and I help financial advisors to run a more efficient practice.
And today, if you look on page 13, we're going to show you how to increase your client acquisition rate by 50% during the close and decrease the time it takes you to do it in half. And the way we're going to do this is, if you look on this screen up here, most people, when they're trying to do the close, are trying to pitch and trying to sell. And Carl, what are we going to teach them to do?
We're going to teach clients how to sell themselves.
And so if you look at on page 14, you'll notice that there's three things that make this program different from all the other close programs you've seen. We're going to teach you why it works. We're going to teach you practical things. There's actually going to be 155 practical things you're going to get today that you can use tomorrow to start closing more and more business. And we're going to teach it to you, and this is my favorite part, in whatever style is unique to you. So we have all four styles up here today. We're going to talk about how to do this. But if you look on page 14 halfway down, this program is literally going to transform how you close prospects. It's going to change the game for you forever. And Carl, if you could give a quick briefing on why or how it's going to do that. How do most reps typically close, and how is this going to change the game for them?
When you look at most reps, what you see is you see a ratio about 33% of people become your clients. So if you meet with and do a thorough fact finder on 3 people, 1 person of those 3 is actually going to become a client. What we look at, and usually what that is doing, and you'll look at the picture on there, you'll see it's a person pulling on a door, and it's almost like trying to push a boulder up a hill, and you're just hoping and praying. We call it the pitch and pray, which we'll be talking about, where you pitch something, you walk people through a great plan, you give them all this great advice, and then you pray at the end that they're actually going to want to do it. What we're going to teach you guys how to do is to ask the right questions, how to not pitch, how to not make statements, but instead turn those into questions, which leads people to then coming to their own conclusions, allowing them to sell themselves.
On page 15, I'd like you all to take a look at some of the worries, the real practical worries that reps have had, that after we interviewed them, they shared with us. Carl and I are going to alternate these, and I want you to star your top 3. One of the things I want to do real quick, though, before we do this is this. All of you watching this video, everyone in this room right now, I want you to put on your vulnerable hat. The one that's the most attractive for you. Because people who are vulnerable and genuine are the most attractive and close the most business. So the people who are going, I don't want to write down the 3 things I want to work on, you might not even want to stay then, because you're not going to make it in this business. The people who make it in this business have the Kanai approach, constant, never-ending improvement. So what are the 3 things? You could have been in this business for 40 years and be the #1 rep in the whole world, and you're still going to have 3 things. And that's, if you look at the best people at anything, they've always got their 3 things. So what are they? I'm going to start. I'd like to grow my business faster and add more clients.
I don't have the snowball effect.
Am I going to get in front of enough people?
The reason I got into this business is to help people solve their problems in a systematic way and build in money, time, and freedom into my own practice. Yet the last few years, that hasn't happened in a way I would like.
I want to make more money.
Convincing people to sit down and talk about subject matter in a very personal way is important to me.
My business is not growing as fast as I want, even though my production is as high as it's ever been. I don't feel good because my performance is lagging right now. I want more assets.
How do I communicate with clients about what's on their mind?
I'm hearing no too often, and it has consciously, even subconsciously affected me. Hearing yes can have the opposite effect. How do I harness this for further activity?
The market performance this year has affected both me and my clients.
I've lost prospecting clients more than I care to admit. How do I get them back, or I'm more satisfied with the process?
I want to write business and expand the network to continually get enough referrals.
When I'm honest with myself, I just don't have strong relationships with my clients.
Being able to keep in touch the right amount and in the right way with clients is a challenge for me.
I've got clients who are a complete drag. A lot of people say, Jason, I've got $250 in premium. I don't need rule the room. How much time is that taking you to do that? How much energy is that sucking from you and your family? Because what's interesting is a lot of people say, I want to come to rule the room to double my production. And other people who don't have the Kanai approach, we call these the cattle or the pigs that are being led to the slaughterhouse. They just kind of sit there in their land of mediocrity because they're making $250 a year and they're fine. But we're talking to the people who are elite reps, the ones who want to go to $1 million, $2 million, $3 million a year and do it in half the time. Carl, how much vacation have you taken this week?
This week?
Or this year?
This year? Well, this year.
This week.
This week. Well, let's see here. It's Wednesday.
No, this year, how much vacation have you taken?
If you look at the last 12 months, I was off about 3 months.
3 months. And in your third year in the business, how much premium did you do?
About 750,000.
And in the fourth year?
$1 million.
Huh. Fourth year in the business, 1.2 million in premium. And he's taken 3 months off a year. Mm-hmm. Wouldn't that be great if you could do that too? On page 16, you're going to get clients putting energy into you. Star your top 3 again. Clients are putting their energy into you. Would you want that more than you're getting now? Carl, what's the next one?
People are filling you up.
You're consistently getting restored.
You have more energy to give to other areas of your life.
You're closing more business.
Your client acquisition rate increases by 50% or more.
Carl, what's your client acquisition rate when it comes to the close?
At this point, it's about 90%.
90. Huh.
What's interesting is that's not synonymous with me. That's synonymous with all of these guys.
All these guys are at 90. How are they doing this? Your prospects routinely say, when can I sign?
Your prospects are incredibly excited to meet with you.
Your prospects truly understand why this is so important.
And you're decreasing the time it takes to acquire your clients.
By how much?
33% or more.
So here's what we're going to do. We're going to put your money where your mouth is. On page 20, I want you to turn to 20 right now and write down the 3 things on page 20 that you just starred. I want you to write them in that box, and I want you to make a promise to yourself and us right now that you're going to do these in the next 3 months. And by the way, 3 months is how long it takes to build a habit. We're going to build some habits for you today. What are the 3 things? Take 1 quiet minute, page 20, and in those 3 blanks, write them down now. We want all of you, including the people on the video, to turn to the person next to you and do something for us for 3 minutes. And it's this. I want you to take a look on this screen because you're going to turn to the person next to you. One of you be the facilitator and the writer. The other person be the relayer and the timekeeper. And I want you to come up with your top 5 list of ways that you and the person next to you can close sales like it's nobody's business. How do you do it? And I don't want theoretical fluff. Oh, you just got to be this. No, I want to know exactly what you do. 5 things, 3 minutes. On the video, same thing. Go. Let's hear what you got. I'm going to write these down. What are your top hitters for how you close a sale? What do you got? Remind them of their goals. By the way, as you're listening on the video, write these down. You're about to get some free market research from your peers. Remind them of their goals. What else you got? Be genuine and do what?
What you say.
Do what you say you're going to do. We're going to teach you in this first chapter how to be more genuine. What else you got? Yep. Create a vision statement. We're going to show you a vision statement for all 4 of these guys today and how you can use that for your own style. Others? Ask questions and listen. One of the things I've learned as I've talked to these 4 advisors is that the best advisors in the world, and these are 4 of them, are some of the best listeners in the world. Whenever I'm with these guys, I tend to like to talk a lot. I'm working with my life coach to do that less and listen more so I can be more attractive like them. Because they're so good at this. They'll always zip it when it's time to do that. What else you got? Upfront contracts. Good. Others? Get a commitment. Serve. Just got a text from my wife today, Jess, and she said to me, Jason, remember, you're serving those advisors today. When you get up on stage, always remember that. That's what you can say to yourself with your clients. Keep them coming. Educating them. It turns out when you're educating, if you want to put in parentheses teaching, you're not selling as much. You'll see as we get clients to sell themselves, we're teaching them as opposed to pitching them. Teaches equate to non-selling. Others? Follow the process. One last one. Emphasizing the plan. On the screen, you'll see 14 sessions. Do me a favor, and if you look on this screen, The first one is how to create irresistible attraction. But we're going to go through these 14 sessions over the next 14 weeks for you watching the video. One session a week, and we're going to start with this one. We're going to get started with this next session called Coach Your Clients. And if you look up at this screen right now, there are 14 sessions up here. And we've done the first 3 over the first 3 weeks. We've got another 11. And I want you to notice that these are prerequisites of one another. It's incredibly important that you take a look at this list right now and start to think about how you're going to do these 14 things in front of your peers for 30 minutes and get a grade. What you're doing right now is in the middle of setting the stage for the close. And most reps will look at us as we're doing this and they'll say, oh, come on already, get to the close. Because in sessions 8 through 14, look at this. We're going to show you how to get them to sell them the solution. We're going to close a life insurance sale. We're going to close a wealth management sale. We're going to teach you how to handle objections. All that stuff, most reps want to just get to it. Just show me how to close a life insurance sale, they say. Oh, those first 7 sessions, if you don't do those right, you can just kiss the closing of the life insurance sale goodbye. So make a note of that in your mind right now as I start to ask these guys questions about how they coach their clients to even get to the point where they can ink the paper. And we'll see this in session number 4. Let's all turn there now, which is on page 130. And if you look on page 130, you'll see a picture of the same person that you see on this screen. And the reality is, your clients, many of them are at the maturity level when it comes to finances of this little kid. And they need your help to coach them through this process. Take a look. We're going to show you how to guide prospects to reach their own conclusions. In a moment, I'm going to ask them some questions, but before I do, I have a question for you. Everyone watching this right now, I want you to look at paragraph 2 on page 130, highlight this sentence, and then ask it to yourself. Are you a product salesperson or a coach? Here's how you can tell. Second paragraph. If you're a salesperson or a coach, the product salesperson focuses the close around the recommendation or product that he or she is intending to sell. Oftentimes, you're describing all the neat features of the insurance sale, or how all of the product and the wealth management has to offer, how it can benefit the client. This leads commonly to a ratio, Carl, of what percent?
33%.
33%. Carl, what's your ratio again?
A lot higher than 33%.
If you want to be a lot higher, and this is true for all 4 of these guys, they all have one thing in common. Look at the next paragraph. They're all a coach. And being a coach is very different. Read it with me. It's about guiding the prospect through a series of what? Underline these. Strategic questions that leads to the prospect, circle this, coming to his own conclusions. The coach is ultimately giving up what?
Control.
How many of you like control in your meetings?
And how many of you are taught as a salesperson you're supposed to control the meeting? Yep. What's it going to take to get you in this car today? Right? Is that what we want to be doing with our clients?
Now,
how genuine does that feel?
Hold on a second. I thought you said that you and you are leaders and you are collaborators. What's the difference between leading and control? I'm asking you.
It's a good question.
What do you guys think? I thought these guys were leaders. Aren't they supposed to lead?
Well, I think when you're control, it's perception, right? So what is the client feeling? Does the client feel led or the client feel controlled? Because if you're controlling something, that's not an attractive word to hear if you're a prospect.
So
right?
there's a difference between being led and being controlled.
I mean, in some respects, leading is control without the prospect feeling controlled.
So it's not necessarily, here's a mentor told me once, he said, Jason, and he told me this about my students, but it applies to your clients as well. He said, Jason, you always want your class of students to feel like they're in control, even though ultimately, who really is?
You are.
I am.
Yep.
but I want them to feel. Is that true with reps and clients too?
But I think like I like using analogies, and the analogy to think about, especially because I like leading people, is think about this. If I'm walking down a trail and I'm leading people down the trail, they get to choose whether they want to be behind me or not. And I'm in control of myself, they're in control of themselves. When you're controlling somebody, you're tying a leash around their neck and you're dragging them down the trail.
So leading and controlling, would you say, are different or the same?
Different.
Very different.
You can lead a horse to water, but you can't make him drink.
Interesting.
Oh, hang on a second.
Write this with me in the box, bottom of page 130. There are 3 ways to coach your clients, and these are universal. Everything in these boxes are universal. Number 1, ask anchoring questions. You'll see these on the screen right now. You can copy them down in the bottom of page 130, and you want to commit these to memory because this is how you do it in the close. Ask anchoring questions. Number 2, share impactful analogies. Share impactful analogies. And number 3, steer the wandering clients back. Here's the kicker. All 4 of these guys up here do all 3 of these things, but they all do them in very different ways. And that's why they're all up here now. We didn't have these guys come up here every other session just because we thought it'd be a difference in variety only. But it's because we specifically chose the sessions where it matters your style as to how your success is manifested. So here we go. Every 10 minutes, I'm going to ask them some questions. You're going to write the answers down starting on page 131, and then I'm going to give you an activity where you have to immediately put this into play in your practice. I have the pleasure of doing session 6 with Carl Duttman, and I want to tell a story about Carl. He didn't know I was going to tell this story beforehand, but before I do, here's the hook of the chapter. Take a look at this little dog. See this little dog?
Aww.
This little dog is begging for a treat. That's what your clients are going to do after this chapter. No, I'm not kidding. Like when I watch him do closes, his clients literally ask him for the recommendation. He doesn't have to say it. They say, Carl, could you please tell me what you think I should do? Now, I want to tell you a story about this because Carl, it turns out, if you look on page 162, here's the hook. We're going to show you how to make the recommendation, highlight this underneath the dog, effortless and certain. In a moment, I'm going to tell this story about Carl, but before I do, Carl, can you set the stage here? It says here, you've secured a commitment with the plan, blah, blah, blah. Set the stage for where we are.
So where we're at is you secure a commitment around the plan. The client's on the same page as you. They understand if they continue what they're currently doing, they'll fall short of their goals. We're now trying to get the client to ask us for the recommendation.
And why do you want to get them to ask instead of just giving it to them?
Because so look at what most people do is what we call the pitch and pray, which you talked about in a couple sessions ago. Where effectively you pitch the person, you say, this is the problem, do you want to fix the problem? People are like, sure. And then you say, well, look at all these great features and all this other stuff. Look at this, got cup holders here and door locks there and whatever it is. And then you pray that they say, yes, I want to move forward with this.
What's the alternative?
Is being able to talk to somebody about, well, what is it that you actually want? So I think this analogy is in here because I like using analogies all the time. At some point, the way I'm going to view this is it says, for Jason, for you and I to work together, it's going to take effort and energy out of both of us. But just to let you know, I treat this like it's pushing a boulder up a hill. So what happens is I'm not going to push that boulder up the hill and give you effectively the treat unless I know that you're going to say once we get up to the top, wow, that was great, let's do this together. I don't want halfway up the mountain, and then you're like, I kind of changed my mind. And then I just push this boulder halfway up the hill. So I'm going to make sure, it says effortless and certain, I'm going to make certain that if I am going to actually push this boulder up the hill, that you're going to move forward with a recommendation.
I want to share a story with you of how powerful this is. Because Carl doesn't just use this as an advisor. Carl and I own a couple of businesses together. And one of the businesses that we own, he had me try to close it without learning this. And I did it over and over again and fall on my face again and again and again. And then he says to me, Jason, I coach reps that have the same problem. I said, well, tell me about that. Carl, tell him about it. Reps that don't do this, what happens to them?
Well, you end up getting discouraged and stressed.
What happens in the close?
Oh, well, so the client gets not engaged, and it's actually pretty, I mean, I love you, Jason.
It's the same thing
but it was
happens to
fun
me.
watching you on the phone. I'm like, I'm just going to let Jason do
Yeah,
his
so
thing.
I would pitch and pray, and I was trying to improve my pitch.
He goes, what's wrong with my pitch?
What's wrong with my pitch?
I remember we had a phone call with somebody, and Jason says to me, he goes, so what are you going to talk about? And this is there's one person-to-person sales, and they're selling to a group of people.
We were selling
to a group of people.
Yeah.
And I said, Jason, we don't need to say anything. He goes, well, what do you mean we don't have to say anything? And at this point, we'd done enough stuff together. He's like, all right, I'm just going to trust whatever it is you're going to do. And within 10 minutes, they're like, we're ready to move forward. And I'm like, we didn't even say anything. It was actually quite amazing.
And bear in mind, 5-6 times before this, I'd been with clients just like this that all said no. Every one of them. And this one says, yeah, sure.
Yep.
I'm ready to move forward. It's so easy for him. Now, here's the best part of all this. This is not something people are born with. You can teach this. And it's universal to all the people. Now, we're going to start it today. And then in sessions 8, 9, 10, 11, 12, we're going to continue it on through life insurance and wealth management and handling objections and all that stuff. And how it all works is on page 163. First, we're going to talk about this box, how to do it, and then we're going to share with you 2 quick conventions, then we're going to roll into the solution. So, Carl, what's the first thing you need to do, page 163, to draw out requests for your recommendation?
First thing we want to do is maintain a calm environment feel.
Some of you are tempted right now to write that and go, oh yeah, maintain a calm environment feel. Yep, I got it. Oh, really? Because when's the last time you had a huge client that you were calm with? Huh.
Perfect example of this is when you move from the end of your fact finder into prospecting. If I were to look at your tone and how you talk and the rhythm and everything else, is there any one iota of change? Because if there is, it's a problem. Reality is, I could sit here and say, my name is Carl Detman. I help people do plans. Is saving money important to you? A jetliner just crashed in France.
Yep.
Whatever else. I mean, it's going to be the same thing over and over and over again. So maintain that calm environment feel.
And by the way, this was crazy difficult for me to learn, but I watched Chris and John and Matt and Carl all have the same tone no matter whether it's going good or bad or if they're transitioning from phoning and prospecting to the fact finder to the close and everywhere in between. They're always the same tone because I literally teach people in order to engage people on stage that your tone's got to fluctuate, which is true. And I had to help coach these guys to get up here and change their tones so they can engage you. But when they're in their office and they're closing, it stays to stay the same. And I had to learn this on the phone. So number 2, Carl, is what?
Monitor the prospect.
What's that mean?
What it means is that if you're intuitive, it's going to be reading the person, seeing how is Jason feeling.
Yep.
If you're not intuitive, you're going to look for signs and cues. So you're going to look for the head nods. I'm going to look for engagement. I'm going to look for asking questions, monitoring to see how engaged you are.
And then number 3 says present your recommendation, but that's kind of the opposite of what the name of this chapter is. When you say present your recommendation, you mean get them to tell you to present the recommendation. Is that right?
It means asking the right. So when we talk about anytime you want to make a statement, a statement would be, Jason, you should save your money risky and safe. You should have a diversified portfolio.
It's advice.
That's advice, and that's what most people do when they present. If I want to close somebody and I want to get them to close themselves, I'll say, hey, Jason, if you're going to save your money, where do you put it? Do you put it somewhere risky or somewhere safe or diversified? What do you do?
That's the difference. It's all questions. Carl said to me one day, he goes, Jason, you were doing that close. He watches me do closes. And he goes, how many statements did you say, Jason? I told him. He said, how many questions did you ask? And I told him. He goes, you want to get to the point where you're pretty much asking 100% what? Questions. Are you there? Are you at 100% questions yet?
And what's interesting is, I'll work with people on this stuff, and right away they'll be making mostly statements, 30% client acquisition. They start doing more questions, it gets to about 50. But what's interesting, to get from 50 to 70 to 80 to 90, it's literally, there's these key questions that it's just a couple of them. There's just a couple. I can look at somebody and say, oh, that statement, that's where you lost the client.
Yep. And when you do your test, we're going to check for this. Questions. Here's something I want you to highlight with me. Take a pen or pencil or a highlighter right now. Turn to page 163. And right underneath where it says plan and recommendations, you all know the difference between those. I'm going to read this paragraph, and I want you to highlight what you like. You ready? Because it's crazy important. When you're able to get the client to request your recommendation, you're much less apt to lose the client because it's what? His idea. Listen to this. It makes things certain in the client's mind, and there's very little room for wiggling. When the client is telling you what he should do, he's stuck to himself. You're able to ensure your client doesn't go away. This is huge, underline this, because he has to betray himself to go away. Carl, what's that mean?
What we're doing is we're coaching people to align their values with their actions. And so it's literally like me saying, Jason, is saving money important to you? Jason's going to say, yes. You're like, okay, well, how much money do you want to save? And you're like, nothing. And it just says, well, help me understand here. I mean, it's either fine, it's fine for you. Help me understand what I'm not seeing here.
Yeah.
And what happens is Jason, to successfully not save, he has to betray his own value. It has nothing to do with me. It has everything to do with Jason.
Carl, how much vacation do you take a year?
Lots. I don't know, 3-4 months.
And you just made a new little deal with yourself, didn't you? Tell them about the little deal on your calendar.
Which one?
The one where you can only get certain clients, and if you can't get them, you're just twiddling your thumbs.
Yeah, well, so for me, when I got started in this business, one of the things that I said was from the hours of 8 to 4, I was either going to see people, be calling to get in front of people, or I was going to be twiddling my thumbs, and literally I was twiddling my thumbs because I realized that if I was going to look on Facebook or whatever else, that I was making just as much money twiddling my thumbs as I was looking on Facebook, even though I could try and legitimize Facebook or passing a long-term care exam or whatever else it was. And so I feel like an easier solution is get a coloring book if you really want to, and like when you don't want to see clients during like prime working hours, just color in a coloring book, because that accomplishes just as much.
And that got you to 1.2 in premium.
Yep.
We all know the deal. But now
But
you're taking to another level,
yeah,
right?
To reality, at a certain point, you look at this, and there's only so many hours in the day. And so if I want revenue to get to 3 million, 4 million, 5 million in a year, I have to change the demographic of people that I'm reaching out to. And so we raised the standard significantly.
I came into his office the other day, and he's got nothing on his calendar. I was like, Carl, you're usually booked with appointments. He's got nothing. I was like, what are you doing?
Yep.
He goes, I'm twiddling my thumbs.
Yep.
Why were you twiddling your thumbs at that day?
Well, I mean, we raised the standard of the minimum prospect to actually a very large minimum prospect. And so anytime you're going to steer the ship in a different direction, it requires you to test different things. And so it's pretty amazing what we've been able to open up so far based on that. But for that hour, I literally
And in future programs, you're going to talk about how you're doing this.
Yep.
So we're going to get there, but my point is for you new reps, this is what you should do, only for whatever your goal is. Now, when we look at this then on page 163, this is the last thing I want you to highlight, because we promised you that this program is going to decrease your energy. The best part is that you're not the one spending energy any longer. The client is. The client's putting the energy into the relationship. So how do you do this?